Hello and welcome to IPO Adda, and my company today is Syrma SGS Technologies. The company is coming out with an IPO which starts on April 12th and closes on April 18th. Price between 209 to 220 per share. The company has an IPO of OFS, which is roughly around 76 odd crores, and an issue of fresh issue of equity, which is nearly 766 crores. And joining me is Mr. Sandeep Tandon, who is the executive chairman of the company. Sandeep, thank you very much for joining us on BQ Prime today.
Thank you.
Let me, you're placed in a very unique space, electronics, and now every industry has that need and is growing at more than 30% per annum. Uh, Take us through. You're raising 76 to 766 crores. What is it going to be used for?
So most of the capital that we are raising is going to be used for plant expansion, capacity expansion. We are seeing tremendous demand coming to us. So we are seeing majority of it for capacity expansion and also working capital requirements.
Hmm. You came out with a pre-IPO placement at 290 rupees per share, raised some 110 crores, and you're pricing your IPO as 220. Uh, and within a span of 2 months, you have reduced that price to 20, which is the upper band for you. Why
So
is that?
So I'm not a pricer of the shares, right? I let the market decide. The world has changed dramatically since April, beginning of the year to now. And our investors are, long-term investors who came into the pre-IPO also are long-term, and they're very okay with, us going out to the market rather than keep this in a state of what we call zombiness, right? Are we listed or not listed? So since the opportunity is huge and we want to grow, and I always believe that the investors should make money. I mean, they're equal stakeholders, and all investors should also make money. So I can't price the company. I mean, I let the investors price the company, and I mean, we're not playing a short-term game. We're playing a long game, and that's what it doesn't matter.
So the pre-IPO investors are logged in for how much? 6 months?
6 months, yes.
Okay. So they come at 290 and you are selling to the existing to new shareholders at 220 a share. Uh, but tell me one thing, in September, October, you did two acquisitions. One is the SGS
SGS we did long before that.
Technique, if
Yeah,
I'm not
technically
wrong.
it came. Yeah, yeah,
Technique,
yeah,
SGS Technique,
yeah,
basically,
yeah.
and Perfect ID, I think.
Perfect idea.
These two acquisitions you did, and at that point in time, you issued shares as well, if I'm not wrong.
Correct.
That was at 53.71 a share. Within a span of 6 to 9 months, you have more than quadrupled the share price to 220 rupees per share. So tell me, how are these two acquisitions going to add value to the top line and bottom line of the company?
No, so these acquisitions have added lot of new customers to our business, right? Both those acquisitions are fabulous in customer accretive, and industries wise, they're actually tying up our industries very nicely. So we serve the industrial segment a lot, and most of the customers of SGS Techniques as well as Syrma are in the industrial segment, and that base really expands because of this acquisitions. And then also, in addition, Perfect ID, what it did is brought us another technology, which is UHF, ultra high frequency RFID. So those added really new skills and new geographies. So more plants in the north, more capabilities in technology, and that's why these two acquisitions made a lot of sense for our growth, and that really improved our prospects with our current customers. So we can offer new geographies and new technologies to existing customers, as well as add a new customer base.
So, I can see the consolidated numbers, how it jumped from 450 odd crores to 1200 odd crores for you. Uh, Give me a sense of what is the kind of growth for these two companies which have come in, because from the prima facie financials which I can see, the EBITDA margins have been under pressure. They have been falling for last 3 years. What is the kind of EBITDA margin? What is the kind of cash flows that these companies can bring in?
So no, so EBITDA margins will continue to be in the low two digits. That's what our steady state. We are expecting our business to be in low two digits now. So there have been some anomalies in earlier where we had done some engineering projects that added EBITDA margins, but typically our EBITDA margins expected will be in the low two digits, not higher than that. And as far as growth, we're seeing sectorial growth completely. So it's not just our growth; it's a sectorial growth that we're viewing right now.
So, roughly around 20-22% of your to nearly 20% of your revenues are coming from these two acquisitions. If I can see from your RHP, what is the kind of growth? Because you have nearly 200 customers. What is the kind of client acquisition that you were able to do with these two companies when you acquired it?
So I wouldn't know exact numbers, but typically we would have added something like about 70 to 80 customers in our portfolio with this.
And this entire revenue, which is coming from industrial, say 34%, is it entirely coming from these two acquisitions,
No,
or you had a exposure
no,
earlier?
we already, so Syrma earlier was very export focused. So we are more export focused, but this has added more domestic business to us. So that is the difference that you're seeing. And then, but as far as customer base and verticals, we are very similar in pre-acquisition and post-acquisition. So the base of the industries that we were serving is very similar.
So the 25% domestic revenues, which is now coming in, is coming in primarily from the new acquisitions. Is that the
I
right
think
way to look at?
domestic revenue is as a combined entity is closer to 50 plus percent,
Okay.
little bit 50%, and exports is about 50%.
So so nearly 20-25% is coming from this acquisition.
Yeah, so we at Syrma, I mean, yeah, erstwhile we had domestic sales also, but we were more export focused. But now, as a combined entity, it's about half.
Sandeep, if you look at the industry as a whole, there's a lot of emphasis now given to electronics. The government is giving it. You have a PLI, which will be there on this for white goods especially,
And telecom, both we have.
and telecom as well. So, how do you see that revenue streams scaling up for you?
So Sajid, I don't know PLI how it. We're not factoring the benefits of PLI with us, but we are really very appreciative of the support from the government, right? Because if when you do mathematics around subsidies, you can't make a business. So we don't take the subsidy of PLI into our calculation. So we are building a business provided that this is interest from the government. It's a nation building activity. That's the government's job. Our job is to make sure that we provide a sustainable business that doesn't depend on subsidies. So but what we are really seeing is the support from the government is tremendous. I mean, it's just amazing amount of interest that the government is taking in driving this industry, and rightly so, Sajit. I mean, if you see the worldwide growth of all nations in the Asian continent, not subcontinent, Asian continent, Japan, Taiwan, Singapore, China, all their growth has primarily driven initially by the electronics manufacturing services. So that part, I think, is really high time that the government pays attention, and we're getting full support there. So as far as my projections, right, I don't see PLI as part of my bottom line, but I see it as my capital investment and top line.
So, what percentage of your capex is now going to go to build facilities for the PLI?
So PLI approvals, I think we would be doing close to 250 that are PLI in the PLI program, 250 crores over the next 5 years.
Next 5 years, and I assume that you will have to finish that fast so that you can take advantage of the PLI.
So it's an annual project, very complex. There are specialists who know how to do this. I'm just focused on the business and the customers. So we have to do capex every year and revenue every year, incremental capex, incremental revenue every year. Based on that, we get the subsidy.
So while you are raising 766 crores, nearly 500 odd crores, you have that capex program which is there for R&D and manufacturing facilities. How many facilities are you coming up with?
So we'll be adding about 3 more facilities and also a new growth in our already brownfield facilities. So expansion in a brownfield and 3 greenfield facilities.
Currently, your exposure to couple of city-based manufacturing is much higher. So, do you have enough uh, capacity in other cities? Because 11 manufacturing facilities or something you have, right? So, in other cities where you've been able to scale it up, is there enough capacity there for that?
in the sense of capacity as in manpower available?
In the sense of capacity as in the facility itself,
So
because four
facilities right
facility
now,
because four facilities account for
right now, our
75% of the revenue.
current capacity, we already did investments of over close to 80 crores uh, just last year in Jan, Feb,
Mm,
March.
mm,
That will take us through our requirements for the next 12 months. Now,
mm.
this new investment will be for the next 3 years.
Okay. You know, your total indebtedness is around 200 odd crores.
Yeah, net debt is,
194, 194
yeah,
or something. That's what
yeah.
it is. My question is that of that 194 crores, a large part of it is, I assume, a working capital requirement for your business, right?
Yeah, yeah.
And that would bring, once this IPO goes through, the company will be able to
So our
reduce
net
it.
debt is 120 crores, not 194 crores, just to clarify.
Yeah, your net total indebtedness,
Okay,
outstanding indebtedness,
okay, okay.
that's around 194
Yeah,
odd crores.
yeah, okay.
So what I'm trying to say is that working capital requirement will bring down some of the interest costs for you. Will that flow into the profits?
It should flow into the profits, but working capital or interest costs, because we do exports also, is not as big a burden.
Hmm.
But the main thing is we want capital to be able to expand capacities. That's the main requirement that we're going after.
What is the kind of cash generation? Because you're sitting, you said that nearly 10% or lower double digit is the kind of EBITDA margins that you're looking at. What is the kind of cash generation that
So
you will
this has
have
been,
every year,
so
or you've
Sajid,
been
what has
having every year?
happened in the past, right? What is happening is this has been very turmoil times for us, right?
Exactly,
With the
yeah.
COVID, what has happened is we are keeping inventories longer because a lot of places we are single source to the customer. So we have to keep inventory so that they don't get hit. And then with the lockdown, then followed with the COVID, and then in addition, supply chain issues, we've been really, very keeping a lot of working capital available. So that has not helped us in the cash generation piece. But our EBITDA margins, like I told you, continue to be in the two-digit number, 11 plus, where we are. So cash generation will be dependent on how we, move forward in this. In these times, but of course we have to ensure that customers are taken care of, and we can ensure serviceability, because these are very critical
Hmm.
components for the customer.
Hmm.
So, but we are very conscious and cognizant of the fact that we want to be a cash generating machine.
Now, since you don't have long-term service agreements with your customers, and it's more of a relationship-based agreements which you have, my question is that are you able to pass on this increase in raw material
Yeah,
cost
so
or
we are a
inventory to
service
them?
provider. Yeah, we are a service provider, right? So maybe inventory holding cost you can't pass, or cost of materials that come increases, we are able to pass on to the customer.
Okay, and that's there in the agreements that
Yeah,
if
those
there
are
is
in
any
the agreement. Yeah,
escalation in
those are in
raw
the
material, that you
correct.
will be able to.
It's a full transparent business model that we work on.
Okay. What about your raw material? Because nearly 75% of your expenses is imported. You do 50% of your exports, they're export, but it's not fully hedged. So how do you hedge this forex volatility? Because in the last 6 months, we have seen rupee dollar volatility being very high.
Yeah.
How do you hedge that kind of volatility?
So no, we are one of the few electronic manufacturing companies that have a natural hedge. Like I said, we have export revenues also, which most of the Indian companies won't have. So that is a natural hedge that we have. So that's a big advantage. Second is we do with the customers we have a hedge, in the sense that they know that if it is a forex exposure beyond a certain percentage, that they have to carry that cost.
Okay. So is there so that's inbuilt in all your
Inbuilt in the
custom.
contracts, yeah.
Okay. Tell me one thing, automobiles is one sector where you have seen you have 20% of revenues coming from there. Consumer is another 20%, and healthcare around 12.7%, which is coming in there. What is the kind of demand that you're seeing for auto companies? We
So,
saw last year a lot of disruption happening because conductors were not there, chips and electronics were not available. Are you seeing benefit of China plus one coming to you?
so sector by sector, I'll tell you, auto, I don't think that benefit is that huge, because it is already they were local. Indian auto industry is very strong, and they've been localizing, and but the demand had been muted for the last 2 years. We are seeing uh, revived demand coming in. That is where in the auto industry. The other consumer industry, huge interest in import substitution. Like they don't want to import, they want to localized manufacture for their electronic requirements. So that's on the consumer industry we are seeing. Then on the industrial side, that is the China plus one that is happening. Industrial side is huge China plus one because people were, sourcing a lot from these large brands were sourcing from China, and with COVID hitting and the supply disruption, actually it has put a spotlight on India. It's almost like I like to say like the Y2K moment of Indian services that has happened for the Indian manufacturing. Suddenly, we are seeing a lot of interest from large industrial names looking at India as a credible sourcing destination. So that is the China plus one that I'm seeing. Did I answer your question there?
Yeah, I get, but are you catering for the kind of demand that is coming in as well in terms of enough adequate capacity so that you can ramp it up?
That's what, that's exactly where I started, sir. That's exactly what we're trying. We are seeing the demand. That's why we're seeing that this is time to grow up.
And the white goods PLI and the telecom PLI will be in that direction.
In the capacity expansion, yes.
Yes.
So both of them are white good is more import substitution. Telecom is both. Telecom is both. So we have export business also coming in telecom now.
So it's more from what, 4G and 5G equipments?
5G infra, home equipment, and other broader telecom products like Wi-Fi and we are very strong in IoT. So that also is parts of some of that will come in Wi-Fi.
How do you see the 5G and IoT now that the 5G spectrum allocation or bidding?
So I mean, it'll take time, Sajid. I don't think it'll be as like tomorrow, but I think the opportunities are tremendous, right? We have seen the growth on people talking to people. I mean, that's 7 billion people, and mobile phone industry is like humongous. Now imagine if it's machines talking to machines, how big that can be, right? And the beauty of that is it's not going to be a single player like Apple or Android going to win. There'll be so many different platforms that will happen, so many different opportunities, and that's what we're most excited about because that's where we play. In
what is the kind of contribution, because today it's not a part of your top 5 or 6, right?
So we don't count it like that. We count our businesses through industry segments, but between RFID and Y mesh, these are the two technologies that we're strong. It's about 25% of our revenue.
Oh, okay.
Yeah, so,
and
so IoT in that sense is 25% of the revenue, but the lines get so blurred when technology is working, right? You don't know where something starts when something ends.
Okay, no, tell me something about the RFID business which is there, because that's a business which is getting disrupted. The margins are getting narrower there because there's so many people who are coming in, and there are alternatives which are now coming in. In that space. What is the kind of R&D that you are doing in that space to expand?
Sajid, you can take it in writing. Every industry that in electronics is going to get disrupted because the technologies don't stay. So it's the way you play, right? So RFID is just a technology, but how you use it, where you use it, how you engage with the customer, and it's still one of the lowest ways to get a machine talking to a machine at low battery for infinite battery right life, because there's no power required. So RFID is not getting disrupted. Actually, it's a disruptor. I would put it the other way. When you talk about commodities, yeah, and commodities will always get disrupted. We try to play outside of commodities where we custom design into a lot of areas. So we play customized. That's why we are design-led manufacturing company. So the minute you get commoditized, right, that's when the pressure comes. So you have to play always one game ahead.
How are you managing that through your R&D? Because R&D expenses have been very low as of now.
So that's India's beauty, na? That's what India comes for. We have lot of talent that is not necessarily has to be top tier, but we got the best passionate people that can deliver. So R&D is as a percentage, so we don't count it completely as R&D, right? Because it's part of a manufacturing-led R&D or R&D-led manufacturing, both ways.
Okay. One another thing which I wanted to check with you is the manpower thing. You had 800 odd permanent employees and 3,500 or 3,800 odd temporary employees. When the new labor code comes in, how does it going to impact your you in any way?
So that we should be fine. We're meeting all the requirements of minimum wage and all those requirements. It's just easier to manage through a contract labor on building the scale that we need, because there's a lot of different areas that we need to bring manpower in,
Hmm.
and through contractors that's easier managed. And that
Hmm.
has been a business model, I think, worldwide this works.
Hmm.
So I mean, as far as cost wise, I don't think that will be a major impact to us.
And do you find enough skilled manpower in
So
this industry? Because
we train our manpower. We go grassroots. We build the strength from scratch.
so in that sense, as there's more expansion in the electronic space, and as government is emphasizing more on manufacturing electronics within the country, do you see challenges coming in with respect to churn in your employee base? What is the
I
kind of
think,
churn that
Sajid,
you
there
have
is not
at least?
a there's not a single industry right now that is not affected by
What is the
churn.
kind of churn rate that you
So
have, or
churn is
attrition rate?
not as high as IT services. I mean, we'll be in low two-digit churn. So low
Okay.
two-digit churn. But see, where we are more concerned about middle management and up, that where we have single-digit or even lesser churn. Where on the factory floor, right? Most of our workers are female workers, and we offer this track to them that is really attractive for their lives. So that's why we are able to retain for longer duration. But at the same time, we design processes around systems rather than people in the
Mm-hmm.
manufacturing setup.
Sandeep, can you just take us through some of your top customers, because your top five customers account for nearly 29% of your revenues. Are all of them outside the country, or are some of them in within the country as well?
So our customers are spread across. I- so we have, I mean, the customers, we have export customers and domestic customers both, and the spread would be, no single customer is over 10% of our revenue.
Hmm.
So no single customer is in excess of 10% of our revenue. And I mean, they're spread across, like I told you, the verticals and the geographies that we talked about. So North America, but most of the countries we serve are North America and Europe for
Oh,
export
okay.
market.
And what kind of repeat business that you get from these
So
customers?
typically, when we engage with customers, they stay with us for life. I mean, from the historic reason. So unless there's a catastrophe on pricing, or a catastrophe on life of the product or quality, they stay with us. So our engagement with customers is, customers have been with us for 16 or plus years. I mean, that's the engagement that levels we see.
Yeah, because you mentioned that of the 216 customers have been there for more than 10 years.
Yeah.
So just wanted to check, the repeat business, how many of them come back with
So
the same
that,
kind
so,
of
so
more?
our so when Sajid, when we engage with a customer, it's not a one-time order, right? This is not capital goods or project
Hmm.
based. It's actually
Hmm.
life of the project that we're supplying for. So we become a vendor to their system. So it's not a one-time order. It's a recurring monthly revenue that we have.
Hmm. I understand that you started the railways segment as well, though it's just 2% of your
Yeah. So
revenues.
we've gotten
What is the
we
kind of work you're doing there, and what kind of
so these are
scale up that can you see
So
there?
we are actually suppliers to major brands in this. So we don't supply. Indian Railways is not a direct customer. There
Hmm.
are customers who are suppliers to the Indian Railway that are setting up shop in India. These are multinationals who we are supplying the electronics to.
Oh, okay. So it's more of a indirect exposure to
Yeah,
railways,
so it
right?
is. I mean, it's direct exposure as far as the industry is concerned, but it's through a multinational who's already won uh, this thing to do.
So this is more of a engines and others components
The
which comes in.
signals on the signals,
Signals basically, which is there. But
signals and
you don't plan to enter into that segment
directly,
yourself.
no. It's too, I mean, working with the government is not our skill set. We are more
Mm.
technology driven, working better with multinationals and brands that we can help create their products. Government requires a different skill set. We don't have that.
You don't plan to vertically integrate yourself to bring in final products at some point
So
in time?
yeah, we would build final product for our customers, not for our needs. No, we are the manufacturer for the brand.
Hmm. So I mean, that's the way
Yeah,
you wanted to do, or
we
you don't
will
want to
keep
create
an
private labels for from your end, because IoT and others are big opportunities for you.
So we have the building blocks. We enable our customers to get more successful. That's our strategy. We really want to be service led design and
Hmm.
manufacture.
Hmm. Finally, Sandeep, give me a sense of how these two businesses that you acquired in September, October. uh, in what rate are they growing? Because we have only a pro forma kind of vision to it. We and from a consolidated point of view, it's only around 5 to 6 months, which may have come in
So
this year.
we had an investment in this. We've been working as one company longer, so we actually did first investment into SGS was in October 2020. So it's almost now 2 years that
Hmm.
we've been working as one company. So it's not not a I mean, not that I see the growth separately. I already see the growth together as one company. So
Hmm.
I don't look at it that what one sector is. I'm looking at verticals and industry
Hmm. Hmm.
customers, that the growth I'm looking at. So that way the growth we've been doing with the last 3 years growth compounded together is about 20%, including a COVID year that we had
Hmm.
a degrowth or a flat year in
Hmm.
20
Hmm.
year ending 21.
Hmm.
So there is growth that is there.
And do you see that growth mirroring the industry growth? Because what you mentioned in the RHP is that industry is growing at a CAGR of 30 odd percent.
Sajid,
Uh,
I really think if I'm out there, I need to beat that, na? I at least meet that.
yeah.
Otherwise, what am I
Will you
doing?
be able to meet that?
I have to do everything possible in this world to do that. Yeah, I mean, it is a very nice time to be in this industry, and I've been looking at this for a long time. So I've seen this industry. This is a good time, and all the stars are aligned for India. I mean, in the sense of the attention we're getting is just never seen before to me. Yeah,
Mm-hmm.
and our engineering talent is being respected worldwide. You're seeing with our services companies, solving that problem. And now, with our market being so fertile, right? Our Indian market being so fertile, customers can't ignore India. They can't bypass India. And
But do you think this business will always have lower double digit margins, right? There's no
so
way you can scale up the margins going forward.
I don't. I don't want to predict better, but of course, it's my endeavor to keep trying to add more value to our customers so they can give us more margins. But I cannot steal margins from my customers.
Mhm. Sandeep, it's been a pleasure talking to you
Thanks,
today.
Ajit.
The Syrma SGS Technologies IPO opens on August 12th. Price between 209 to 220 rupees per share. Price is the company at 3,877 crores at the upper end of the price band. Thank you very much for joining us on
Thanks,
IPO
Ajit.
Adda.
Thank you. Bye.
Bye.